Hello, everyone. Thank you for joining today's COVID-19 Impacts on Employee Benefit Plans webinar. Before we begin, I have a few housekeeping notes. Handouts for today's presentation can be found in the toolbar located on the right of your screen. Also, at the bottom of the toolbar, you will see a chat box. Please submit questions for our speakers here, and we will do our best to address them during the webinar. And finally, once the webinar is over, there will be a pop-up asking you to complete a survey. Please take a moment to complete it. And with that, I'm going to turn it over to Wendy Terry, partner at Withum and today's moderator.
Well, good afternoon, everyone, and welcome to our webinar today. We will be talking about, as Jen mentioned, COVID-19 and the impact to employee benefits. I am Wendy Terry, and I'm a partner at Withum, and I'm also the practice leader for our employee benefit plan practice. And as part of that, we audit over 700 plans throughout the country. And so we have quite a bit of experience dealing with various issues that are coming up with the COVID. I'm also a member of the executive committee of the American Institute of Certified Public Accountants, the Employee Benefit Audit Quality Center. What a mouthful that is. Also, you may have heard it as the EBP-AQC. But as being part of that, I have an opportunity really to review and implement many of the guidance that all auditors throughout the country use in our profession. So it's good to be able to be involved with that. With me today, we have two individuals who are very knowledgeable on the topic of the CARES Act and also the Families First Coronavirus Response Act. Boy, another mouthful. This one is also known as the FFCRA. But before I introduce them, we want you guys to be as involved and interactive in this presentation. So I really encourage you to add questions to the chat. We do have some that were pre-populated, so I'll be going through those, but I think it's important for you to add as many questions that you may be thinking about so that you can benefit from this. We will have each presenter give an opening statement, and then we'll spend the majority of the time today talking about or answering your questions. So let me introduce to you first Sean Linde, who's a manager at Withum, and he specializes in the firm's ERISA services. He has over 12 years of public accounting experience, and he has extensive experience managing financial statement audits. And he's also a frequent presenter at conferences and workshops on emerging accounting and ERISA topics. In addition, we have Lindsey Surratt, who's an area senior vice president at Gallagher. Lindsey is an attorney, and she leads the Southeast Region Legislative Compliance Team. She uses her knowledge of the Affordable Cares Act, COBRA, HIPAA, ERISA, and other areas that the IRS tax code may have that specifically impact employee benefits to help her clients and employers identify concerns that may, and also to make recommendations on how they can improve their benefits so that they can be compliant. So Lindsey, can you take a few minutes to tell us about Gallagher and also your thoughts on the current issues that are impacting your clients today?
Sure, thanks Wendy, and I'm so happy to be here today. So first, a little bit about Gallagher. Gallagher was founded in 1927. We're headquartered just outside of Chicago, and we're one of the world's largest insurance brokerage, risk management, and consulting firms. We have offices in 33 countries and over 30,000 employees worldwide. My team, the Southeast Region Legislative Compliance Team for Health and Welfare Benefits, is part of our Employee Benefits and Human Resources Consulting Division, which provides support and solutions for health and welfare benefit plan consulting, which I'm going to talk a little bit more about today, retirement plan consulting, executive benefits, HR technology, data analytics, and several other practice areas. So my team is just one small part of that. Since late March, we've seen just an explosion of regulations and guidance relating to COVID-19 that has focused on consumer protections, employment rights, benefits, economic stimulus, and funding. On the health and welfare benefits side, it's felt almost like the height of the ACA's implementation back in the 2012 to 2015 timeframe, but crammed into just a few short months. Employers have had to navigate leave of absence changes, group health plan changes that are required under the FFCRA and the CARES Act, which were both passed back in March. Seems like ages ago now. The Families First Act, or the FFCRA, included 2 new paid leave provisions that apply to employers with fewer than 500 employees and to public entities of any size. And those are the emergency paid sick leave provisions and public health emergency leave, which is also referred to sometimes as expanded or emergency FMLA. In addition, employers have had to determine which optional relief they want to implement and frankly can afford to implement under all of the additional guidance that's been issued by DOL, IRS, Treasury, and HHS that's really been given in order to provide some relief from existing rules that are really hard to comply with right now. So all of this has come during a period of really immense stress on businesses. Early on, most of the questions that my team received were related to how an employee's benefits would be affected by a layoff, a furlough, or reduction in hours, and sometimes all three. The outcome of those questions could and did vary really widely, depending on how the employer's health and welfare benefits were funded, State Department of Insurance directives regarding payment of premiums, specific eligibility terms, and the employer's exposure to ACA penalties under the employer mandate, among others. At that time, we also fielded a substantial number of questions about emergency paid sick leave and public health emergency leave, including which companies have to comply, who's eligible, the qualifying reasons for the leave, and documenting the proper administration of the leave, which is essential if you're an employer that intends to claim the payroll tax credit that's available to help offset the cost of paying for that leave. So as the pandemic progresses, we still get those questions, of course, but we've certainly seen an evolution in the questions that are health and welfare related that are facing employers since then. Our clients are reevaluating how to comply with notice and disclosure requirements for a workforce that's either fully or partially remote. If employees were furloughed or laid off and are returning, employers are also dealing with how their benefits decisions on the front end of that layoff or furlough affect the employee's return to work and their benefit options at that time. We've also seen claims utilization under most health plans that slowed down due to a decrease in elective surgical procedures, closures of dentist office, and other factors. And that's resulted in carriers issuing premium credits, leaving employers wondering how they have to use those credits. We've also seen a fair amount of activity from the agencies on non-COVID related matters that were kind of in the pipeline before the pandemic. So with new guidance that has been coming out each week and every day, it feels like sometimes, employers have really been challenged to be nimble enough to react quickly, and we expect that to continue in the near term.
Our new normal, right, Lindsay?
Absolutely.
Well, Sean, I'm sure you have also had some experience with some of the issues related to COVID. Can you give us maybe a few minutes of your thoughts on how is this impacting your clients and, you know, maybe even your audits?
Yeah, sure. Hi, everyone. I'm Sean Linde, a benefits manager with Withum. Happy to be here. I know we have a lot of our longtime clients joining us in attendance, and we appreciate that very much. So with Wendy's and Lindsay's comments, I just wanted to also add that you know, from my perspective, from our firm Withum's perspective, as a benefit plan auditor primarily, we're seeing that you know, a lot of issues are surfacing during the audit, right? And naturally we're always looking back 1 year. So in our role, we'll be looking at 2020 and all the, the unprecedented changes that have happened in 2020 and 2021. And unfortunately, it's going to be too late for us as auditors and also advisors to share that information. So we're happy to be here today to bring that information to you live as these events are unfolding. So just a few thoughts of what we're seeing. In March, when CARES Act came into play, late March, we immediately started thinking as a firm, how is this going to impact our clients? And a few things rose right to the surface. We typically see issues with eligible compensation, and with all the new compensation, all the new wages that employers may be using to address furloughs, leaves of absence, this could create a issue with eligible compensation, as well as employees' funding, like the actual funding of employees' money to the plan. Everyone's in a remote work from home environment, or most people are. So the processes and the controls that usually surround funding those employees' withholdings may not be occurring the same way, may not be occurring in the same time frame that they usually are, and could result in administrative headaches down the line. So those are just two areas that we've seen, and we've got some questions coming up in this presentation that are going to kind of get to the crux of the issues rather than just covering content.
Great. Well, let's jump right into the first question that I have here. So, Sean, as an employer, right? We have a lot of employers on the call today. Are the employers required to implement the CARES Act provisions?
Thanks, Wendy. Yeah, this is perhaps one of the most interesting questions, because when the CARES Act came out, myself, I believe a lot of our clients thought, okay, this is going to be a required implementation. We're going to have to move fast to implement this, and absolutely not. That's not the case with these CARES provisions, and the provisions that I'm speaking about specifically relate to retirement plans. So your 401ks, your IRAs, 403bs, namely coronavirus distributions, the enhanced loans to those qualified individuals. Those provisions are not required to be implemented, not required that the plan operate them or add them in any form. I think that's, right out of the gate, that's the key thing. It's really up to the employer and the management of the plan's discretion to whether and how in depth they would like to implement those provisions. The question that comes from that is, if we decide not to implement these CARES provisions, well, how are our employees out of luck? Are they not going to be able to access those tax favorable benefits that CARES has through retirement plans? And the answer to that is yes, employees will still be able to access them as an individual on their tax returns. So no, that there's no requirement to implement, but yes, the employee, regardless whether the employer implements, will still have access to the tax favorable benefits.
Lindsay, do you have anything that you might want to add to that?
Yes, so there are some CARES Act provisions that are also really important for health plans in particular. And one of those, coverage for testing for COVID-19, is mandatory and must be covered by all group health plans. That includes coverage for diagnostic testing as well as serological or antibody testing. And it's a pretty broad coverage requirement. It includes really any cost to determine whether a test is medically necessary and the cost associated with actually administering that test. So that's one important health and welfare provision under CARES that's required. But there are also a couple of other CARES Act provisions that are specific to health benefits like Sean mentioned, that are optional, like the ability to expand a health reimbursement arrangement, for example, to cover over-the-counter drugs without a prescription.
You know, it's interesting. We had at one of our meetings at the Audit Quality Center a discussion about how some providers are automatically, some of the employee benefit plan providers that have prototype documents are automatically including these provisions in their documents. And so employers should probably also make sure that they didn't arbitrarily, right, Sean, arbitrarily accept just because they had an opt-out provision, where a lot of these guys were just kind of saying, we're going to just do it for all of our plans. And, you know, if you're a part of our plan, you're going to automatically, unless you opt out. So I think employers should be checking on that as well. So Lindsey, when an employee is furloughed, or they return from a furlough, or they're rehired after a layoff, are they treated as a new employee, or are they just continuing their employment for the purposes of health benefits? Can you talk about that?
Yes. So that is an excellent question, and this is a 100% attorney answer. It depends. There are going to be a number of factors that an employer needs to consider to determine really whether an employee who is laid off, so when we use the term layoff, we're talking about an actual termination of employment, a formal termination. Furlough, on the other hand, the person generally remains employed, but they're not working any hours. It's going to depend on things like the length of the break in service. How long was it? If it's very short, typically the person comes back as an ongoing employee. If it's longer, the person may be forced to, for example, satisfy a new waiting period to resume participation in the health plan. The employer's plan documents. So we were just talking about plan documents and the importance of those terms. The plan documents, terms, and the insurance contracts, if the plan is insured, will also impact the employee's options and their status when they return. And if the employer is an ALE, so if they have 50 or more full-time equivalent employees under the Affordable Care Act, that risk of penalties might also play into the employer's decision about whether or not to be more generous maybe than the law requires in determining whether an employee should be reinstated immediately, allowed maybe to make new elections under the plan, or whether they have to satisfy that new waiting period like I talked about.
Interesting. Yeah, I you know, that's a new, I think that's a new term that we all are getting used to hearing, furlough and laid off. I mean, and to understand that there are differences is pretty important. Sean, you talked a little bit about the coronavirus related distribution. Can you talk about what the big advantages over, say, like a hardship distribution?
Yes. So this is really important. Not only for the employers, but even as an employee listening, if you or someone in your family has been impacted by this virus, it's extremely important to know the benefits that you can access through your retirement plan. So far and above the attention in CARES has been in the retirement world has been to a coronavirus related distribution. That's a mouthful, so we'll just say CRD. So CRDs offer a couple great benefits if you're a qualified individual. So the first key benefit is there's no 10% early withdrawal penalty. As most of you are familiar, if you're under 59 and a half, you are subject to a 10% early withdrawal penalty, and that is waived. Secondary is there's no 20% mandatory federal withholding upon these distributions. There is an optional 10% withholding form that's used, but that is optional. So if you're requesting a distribution, you're essentially getting dollar for dollar from your account that amount. Now, on the individual taxation side, the IRS did not go ahead and say this is going to be tax-free money. It's still going to be taxable income. However, the key benefit here is employees can elect to spread the taxable income ratably over 3 years. beginning the year of the date of distribution. So that distribution has to occur in 2020. So 2020 would be the initial year if you elected to spread that over 2021 and 2022. And then the last real benefit that a CRD gives as opposed to an ordinary in-service distribution or a hardship distribution is the participant has the ability to repay that. So a participant can repay that contribution to either the plan that they withdrew it from, if the plan accepts that, or an individual IRA, and they can avoid any tax liability for the amount that was repaid. It doesn't need to be repaid in full; it can be repaid in whole. So those are really the key advantages. And just one additional one is that for a coronavirus-related distribution, the maximum amount, as you may know, is $100,000 set by statute. Now, if you have a financial adverse consequence, or if you're otherwise impacted, for a hardship, you need to prove an immediate and heavy financial need for the amount to be warranted. In the case of a coronavirus-related distribution, there is no need to substantiate the amount of financial need. You can access up to $100,000. So those are really the key differences that these distributions have compared to any other distributions that we know of.
So Sean, you said that an employee has the option of making an election. Is that a formal election, or can they just pay it back in 3 years and be covered?
A participant would need to make a formal election with their individual tax return to elect to spread that ratably over 3 years.
That's a good information for the participants that might be on the call.
Yeah.
So that being said, let's switch over. Lindsey, when we're talking about the plan documents, do we need to take any action or review or amend any of our plan documents in order to take advantage of these provisions?
Yes, that's very important. I know they don't feel like it sometimes, but plan documents are your friend. They really should serve as the guidebook for the administration of your benefit plans. And that's, I think, true across the board, both in my area of expertise in health and welfare and on the retirement plan side. I know that's one of the things that Sean and I talked about earlier this week. And whenever you're determining who is eligible for a benefit when coverage begins and ends, which is really important right now, and what benefits are covered, which is also really important right now, you should look to that document. In general, the health plan documents should be amended to reflect the changes that are required by the CARES Act and other DOL and IRS guidance. I know, Wendy, you mentioned earlier, TPAs and other vendors may be making some amendments to those documents themselves, and we're seeing that on our side as well. And it's been interesting because sometimes those amendments are reflecting changes that are beyond what's required by the law. And so it's important to know, as an employer plan sponsor, are you okay with those changes, and what do those changes cost, and how might they impact your administration? So absolutely, yes. At the very least, review your plan documents. On the health and welfare side, if you want to take advantage of any of the optional relief that the IRS has given us from some existing rules, you also need to amend your plan documents in order to do that. So important time to take a look at those pieces of information.
And to your point, it's not going to be a surprise. They're going to send the employer something that they have to sign, correct? So, yes. So be on the lookout if you're getting something in the mail and it's from your third-party administrator or your plan advisor, and you need to sign it. It's probably something that's changing your plan, and you need to be aware of it. And again, some of them I've seen are opt out, so you only have to send it back if you're opting out of the change. So be careful that you're paying attention to that. Sean, do you have anything to add on that?
For the plan documents, I do have something short to add. So what we've been seeing is a lot of the large service providers of the industry are pushing out these auto amendments, auto adoptions, and plans need to be careful, because if you're auto amending and auto adopting certain provisions into your plan document, then you need to conform the operations of the plan to meet those. One of the things we see in our audits is that the plan has the best intentions to manage and administer the plan, and a service provider went ahead and changed a feature of the plan or amended for a regulatory reason, and the operations of the plan just never caught up to those changes. So it introduces a potential area where there could be some compliance issues down the line.
Okay, just another question here. This one's from our chat room, Sean.
Yes.
My spouse has experienced an adverse financial consequence as a result of a reduced hour furlough layoff. And I know you spoke or you mentioned before this term. So the question is, does that make me a qualified individual?
Well, today it does. Last month it didn't. That's really the way that the regulations. I think in the push to have CARES into law March 27th, there may have been some oversight, and this may have been one of them, because as soon as CARES was passed, we had a significant volume of questions come in from our clients and individuals on whether a spouse would qualify the participant to access some of these favorable provisions under CARES. And so the short of it was, we had to tell our clients and contacts, no. If your spouse was adversely financially impacted, for example, if your spouse was furloughed, however, you as the participant did not have any qualifying events. For instance, you did not have COVID, your spouse did not have COVID, and you weren't financially adversely impacted, then you would not be able to be considered a qualified individual, and you wouldn't have access to some of these relief forms. However, we were seeing a lot of individuals were saying, well, that's not really fair, because our spouse may contribute a lot to household income, and if the spouse is impacted, why should that not qualify us? So I think on June 19th, the IRS issued a notice indicating that they had expanded the criteria for who qualifies as an individual for these CARES provisions. And so the main takeaway from that was, not only does the adverse financial consequence, for instance, reduced pay, reduced hours, termination of employment for a spouse, now qualify the participant, but also a household member. If a household member has suffered any financial adverse consequences, that also qualifies the participant. So that was about a month ago that came into light, and I'm sure a lot of people are enthusiastic to be able to access these favorable distributions with those changes.
Okay, I have another question from the audience, and again, it's not directed to anyone in particular, so feel free to chime in, either Lindsay or Sean. The question is, could a 401k loan default taxable distribution, code L, be considered a CRD, then allowing 3 years to repay or spread tax over 3 years?
It depends. I guess it depends on the date when that loan was defaulted, but generally there is a synergy with that, where yes, if a loan becomes defaulted in 2020, that could be the participant or the individual on that individual's tax return could then claim that deemed or loan default as a qualified distribution. or as a coronavirus distribution, and the favorable tax effects that those come with. So it depends when that default happened. If it happened in 2020, generally, yes, that could be then recharacterized as a coronavirus-related distribution.
And a lot of times we need more specificity about the information. So again, to whoever typed that in, feel free at the end or later, we'll have our contact information. You feel free to reach out if you want to give more specificity to the information, and we'll sure we can get to the right answer for you. This question is for Lindsey. Lindsey, is an employer entitled to multiple periods of emergency paid sick leave or public health emergency leave before the end of 2020?
That's another question that we've gotten pretty frequently, and so before I answer it, I'll just distinguish pretty quickly between emergency paid sick leave and public health emergency leave. Emergency paid sick leave provides up to 80 hours over a 2-week period of paid leave for 6 specific reasons. Those include issues associated with a physician's recommendation for an individual to quarantine due to COVID-19 concerns, caring for a family member who's been advised to quarantine, your own symptoms and you're seeking that medical diagnosis, and a handful of other reasons. Expanded FMLA or public health emergency leave, on the other hand, is a new reason for FMLA to care for a child whose school has closed or whose daycare provider isn't available. So sort of a couple of different types of leave there. But unfortunately, the answer is the same, for both, and that is you get one bite at the apple. You get one period of leave. Emergency paid sick leave, one period of up to 80 hours over a 2-week period of leave before the end of 2020. So if you take it for one reason and then you experience another reason later in the year, you can't take it again. You've exhausted your leave entitlement. Similar answer for public health emergency leave. If you use that 12 weeks, you don't get another 12 weeks before the end of 2020. And also, with public health emergency leave, if you've used your entitlement to FMLA already, let's say that you've used it for a maternity leave for the birth of a child, and you have none of your FMLA remaining until your 12-month reset, then you don't get an additional 12 weeks of public health emergency leave either. So one bite at the apple for each type of leave through the end of 2020.
Wow. Sean, this question is for you, and I know you may have mentioned already what a participant needs to do regarding self-certifying. Maybe you could talk a little bit about that, but as an employer, does the employer have to maintain the employee's self-certification with respect to being a qualified individual?
Yeah, sure. And this is definitely an audit-driven question, and not just for a financial statement audit, but also for a potential DOL audit. But so really, the benefit of CARES and the statute is that an employer does not have the responsibility to determine whether a participant is actually a qualified individual. And there's certain criteria, we've touched on already, whether there's financial adverse consequence or whether an individual has actually contracted COVID. So those are the automatic qualifiers. So the statute says that the employee or the participant is the one to self-certify. So in light of that, employers or their service providers, plan administrators, should be using some form or a template letter to indicate that that employee or participant has met one of the criteria. Now, they do not need to specify which criteria they've met. They do not need to indicate whether they've contracted the virus, a spouse has contracted, or they have suffered financial adverse consequence. They just need to indicate that they have met one of the criteria. The employer then should maintain that for purposes of an external audit, because that information will be key in verifying that the operations of not having tax withheld, for instance, was performed in accordance with a CARES distribution, and it should not have been a hardship or otherwise a type of distribution.
Okay, good response. And I know a lot of people really to do that, because when you come out a year from now or 2 years and you're asking for that piece of documentation, it's kind of hard to get, right? It'll be after the fact. So important to get that information before or while people are thinking about it. I have another audience question here that I'm going to throw out. And again, I'm not sure, it wasn't directed to either anyone in particular. So which provisions, and I'm sure they mean which provisions of both the CARES Act and the FFCRA, which provisions to employers with under 500 employees applies?
I can start with that one.
Okay.
So if you're if you're thinking about the FFCRA and the paid leave provisions, those apply to employers with under 500 employees, unless you're a public entity, and then it doesn't matter what size you are. When it comes to other health and welfare provisions, like the requirement to cover testing for COVID-19 under your health plan, that applies to all health plans, regardless of size. So there's not a size threshold for that type of provision or other health-related provisions under the CARES Act related to telemedicine reimbursements or the purchase of over-the-counter drugs and medicines without a prescription. So those have no size threshold.
Okay, yeah, that's good to know. It's interesting how the government determined different size levels to make these benefits available to employers and employees. I will throw the next question out to Lindsey. So employees have contributed to their health FSA, their HSA, maybe their dependent care assistant programs, but let's just say they weren't really able to use the funds this year, right? A lot of daycares closed, a lot of people weren't necessarily going out and having to go to the emergency room or have a lot of costs or healthcare costs. Can they change their elections to maybe move some of that money? Talk about how their elections for the year work.
Yeah, so maybe. It's interesting because election change questions, even pre-COVID, as far as volume that we handled, were second only to questions about the ACA. And so it wasn't a surprise when we started getting these types of questions. If an employee who's contributed to a dependent care account and that dependent care daycare provider closed, so the employee isn't paying that provider anymore, they've experienced a significant change in cost. And most dependent care plans are drafted to permit an election change on that basis. And there are typically some requirements on how quickly you have to notify the plan that you want to make the change. Health FSAs, on the other hand, are traditionally much less flexible. The IRS requires you to make an election for a 12-month period, and you can't change that unless you experience certain life events. And for a long time, the first couple of months of the pandemic, we didn't have any guidance from the IRS indicating that a person who had just contributed $2,600 to their health FSA could change that at all, even though they couldn't go to the dentist because the dentist was closed. They couldn't use it for an elective procedure that they had planned on. And so participants are really in a tough spot. And back in May, we did get IRS Notice 2020-29, which gives employers the option, so this is one of those optional things that we were talking about, to amend their plans to permit certain election changes during the 2020 calendar year only. So employers will need to look at that notice, consider what type of that relief they want to choose to adopt. And if they choose to adopt that relief and make changes to their plans, they can provide their employees with some additional flexibility to make election changes. A couple of important notes there, though. Regardless of the type of election, those types of election changes are always prospective, so they can't be retroactive and go back to a prior date. And we've also gotten some questions about whether or not the IRS will permit employers to refund contributions that have already been made. And the answer, unfortunately, to that question is no.
Okay. So interesting. You said the employer has to make this amendment. What if the employee wants to change? I mean, I assume the employee can go in and stop contributing to the future contributions to their HSA, correct?
HSA contributions can be changed on a monthly basis at a minimum.
Yeah.
So HSAs aren't subject to quite the same rules as the FSAs and the dependent care accounts are. So employees will have much more flexibility with their health savings account contributions than they will for contributions to a health FSA or dependent care. But that raises another important question. HSAs are portable. They're bank accounts that are owned individually. Health FSAs and dependent care assistance programs are not. And if you have a substantial amount of funds accumulated in those accounts that you sponsor as an employer that employees aren't able to use for reimbursements, and they can't change their elections retroactively, you may have a surplus of forfeitures at the end of the year that you want to think more carefully about how you use as an employer. And of course, like everything else, there are IRS regulations and ERISA regulations that will impact how you're able to do that.
That's good information. So Sean, I'll throw this one at you. As an employer, are we required to provide any notification to participants regarding the CARES Act or provisions of the CARES Act?
Yes. So with that question, I'm going to speak on the retirement account provisions of the CARES Act. Meaning the coronavirus related distributions, loans to qualified individuals, suspension of required minimum distributions, and certain changes to the defined benefit plans. So with those, the statute in CARES did not describe any requirement to provide participants notice of the changes. If you implement, if as a plan you decide to implement those provisions, are you required to provide participants with the notice that, hey, now you can access this distribution if you're qualified. Now you can access a greater amount of a loan if you're qualified. No, there is no formal requirement to notify the participants. However, we're seeing it's been best practice to notify participants. I think the last thing a plan wants to run into is maybe those managing the plan or maybe those in senior positions have an understanding that the plan has implemented these, but the rest of the employee base does not. So if a audit or Department of Labor audit were to kind of identify that the officers of the plan had accessed some of these CARES Act provisions, but the remaining balance of the plan did not because they did not know about them, the plan could potentially fail a benefits, rights, and features test, and it could create a headache. So it is good practice to notify, I believe, a lot of the service providers. The large TPAs of the world are assisting in notifying participants, but as an employer, you should just make sure that communication is consistent and aligned with what the plan is operating.
Yeah, it's kind of like more information is better than less information, I assume, right?
Correct.
Lindsay, do you have anything to add to that you've been seeing?
Sure, yeah. So the FFCRA does have a notice requirement that's related to those paid leave provisions. So you're probably used to, if you're in HR, posting your FMLA poster on your workplace. There's a similar poster for the FFCRA leaves, but if your employees aren't on your physical work site, they may not see that poster. So
that's what I was going to ask. That's funny. Like now we're all working from home.
So you got to post a poster, but the DOL has also issued some guidance about distributing that electronically, so participants and employees are aware of their leave requirements. Under the CARES Act, for the health and welfare related provisions, if you modify your plan, particularly if you're a private employer that's subject to ERISA, that plan change will likely trigger a summary of material modification. So you would need to make sure to not only amend your plan, but then also prepare that notification for your plan participants and make sure you send it out timely as well. So it's not an explicit notice requirement in the CARES Act, but there's a separate notice requirement that's going to apply if you make any changes to your plan.
So following up on that, we've heard that we're required to provide participants with additional time, maybe to request HIPAA enrollment, special enrollments, and also to elect and pay COBRA coverages. Is this optional, Lindsey, or is it mandatory?
That guidance, if you are a private employer, is mandatory. It's not something, unfortunately, that you can choose to implement or not. And it is quite complex. Employers we've seen tend to get that guidance that we refer to as the outbreak period guidance sort of mixed up with some of the IRS optional guidance that we've received. And the tricky thing about that is, you're right, that Wendy, it does give participants additional time to request HIPAA special enrollment in the plan if they've gotten married or if they've gained a new dependent through birth or adoption. It also gives them a time to elect and pay for COBRA coverage and submit claims and appeals. The tricky thing, though, is that we don't know when the end of that outbreak period is. It's 60 days after the end of the national emergency, and there's been no declared end to the national emergency yet. And so it's pretty open-ended for plan sponsors. And I think specifically when it comes to electing and paying for COBRA coverage, that leaves a lot of employers wondering, okay, how long do I have to leave this door open for a participant to decide that they want COBRA coverage to continue that health insurance, and then how long do I have to wait for them to make their premium payments? So that is mandatory. We've seen a little bit of confusion from vendors who are maybe making some of those plan changes automatically that you were talking about and how they administer this. So keep an eye, like Wendy said, on those notifications, especially if it mentions HIPAA special enrollment, COBRA elections and payments and claims and appeals.
Sean, do you have anything maybe that you're seeing in as an auditor that might relate to these extensions?
Well, yes. On a similar topic, I think we, as auditors, we have a level of empathy for a lot of the employers with not only these CARES regulations and who knows what other regulations are forthcoming, but also the Secure Act and a lot of the regulations that those brought that are beginning to be effective. Though I would advise that there is a bit of a runway to formally adopt some of these CARES and Secure Act provisions. So I would caution employers to not rush to formally adopt anything, because there is a runway. I think for the CARES provisions, you have until December 31 of 2022. So 2.5 years just about to formally adopt any changes you make. Of course, you have to operate in conformity with the statutes until those are adopted. But as far as the formal adoption and when those are happening, I would just urge you not to rush to get those adopted and to carefully consider them, because you not only have secure regulations, but also CARES Act regulations.
Great. All right, getting close to the end. We've got about 10 minutes left, so I'm going to try and get a few of these questions that we have pending in. The question here I have for you, Sean, this is probably a straightforward one. Has the 2019 Form 5500 deadline been extended for our 12/31 calendar year end plans? And if they, do you think they're going to extend it? What's your thoughts there?
Well, yeah, I think we'd all like to know, right now, if there was an extension. I think if there was an extension, I'd probably be planning a vacation in October. But
me too.
Yeah. As you know, for calendar year plans on extension, October 15th is the due date for the Form 5500s for benefit plans. So right now, there is no word on whether that date will be extended. There is also no date on whether, without extension, the July 31st deadline for calendar year plans will be extended, and that's looming in 2 weeks. So no word yet. But in this environment, it's day by day. So we were to urge you to kind of keep a lookout, and we'll keep a lookout, and we'll be emailing all of our clients and contacts if we do find out that there is an extension. But right now, there's no extension.
Back to just, your observation as an auditor. A lot of what we do is done remotely now. So do you think there's a need for the extension? Would it impact what you do to complete the audit? Maybe you could talk a little bit about that.
Sure. Yeah. We're a few months into our traditional season of working with plans on their annual audits. So far, there really haven't been too many challenges working remotely. I would say that the challenge may be on the employer side if they had to furlough individuals who are in that back office role, and resources are spread thin, and there are a lot of priorities that are reshuffling every day. So I think on the employer side, there may be incentive. For us on the service provider end, we've been able to work remote, and that hasn't caused any delay. But it's something that I think employers, especially in certain industries, could be in great need of an extension.
It's interesting. One thing I do, again, sitting on this committee, there's the top 10 firms in the country are on this committee as well. And the IRS did give an extension for 11K filers. Those are the public companies that file for employee benefit plans. And they gave an additional 45 days. And one of the questions that went around the room at that time was how many firms had actually found their clients were taking advantage of that 45 days. And there were almost none. So it was pretty interesting to me that, we also as a firm did not have anyone that had a need to take advantage of that 45-day extension. But I do think it's interesting that the tax rule, obviously we just went through tax day yesterday. Usually it's April 15th, and it was yesterday, July 15th. Hence why we scheduled this for today for Sean and I. But I do think that it's going to be probably not a big deal to have the benefit plan season for the 5,500 filing extended, but we'll see. Well, let me ask you a question, Lindsey, before. I think this is kind of an all-encompassing. What other benefit compliance issues should we be aware of right now?
Yeah, so, the agencies, you would think DOL, IRS, HHS, Treasury, they're all focused on COVID-19, but we've actually seen a fair amount of activity on non-COVID matters. I was personally hoping they would give us a bit of a breather and not send out just sort of random new ACA rules while we're dealing with all of this, but we've gotten new regulations under the non-discrimination provisions of the ACA, Section 1557. We've gotten new regulations for grandfathered plans that aren't too quirky, so that's not too bad. If you've got a wellness program in place, we're expecting new wellness program regulations under the ADA and GINA at any time. And then we've also got a lot going on with the Supreme Court. We've had a couple of landmark decisions lately that will have an impact on benefits. We also have yet another challenge to the ACA that is going to take place this fall in the court, with a decision to be issued likely in the spring of 2021. We've also have been hearing a lot about additional discussions for another stimulus package that is likely to include some more benefits compliance provisions. Conversations about a COBRA subsidy are very popular now. If you have a job and you lose that job, as many have, you lose your insurance unless you can afford to pay the cost of COBRA coverage. And so we're seeing that a part of that conversation, and also likely some provisions around surprise medical billing as well may be included in that. So COVID certainly deserves a lot of your focus right now, but I would say don't lose sight of those other things that are coming down the pipeline.
Excellent point. Excellent point. Sean, I think this may be on people's minds as far as, if they're not able to make contributions timely, that happens, especially in this environment, whether it be because they can't physically do it or because they may not have the funds. Will the Department of Labor look to be penalizing employers if they remit employee withholdings later than usual due to these changes in the workforce or the environment? I know that obviously as an auditor, you probably spend time looking at the timeliness of employment or contributions for employees. Can you talk a little bit about that?
Yeah, definitely. So this is an area that we encounter probably more compliance issues than any other area, because it's subjective. There is no hard and fast rule that the IRS has provided for when an employer needs to fund these, other than as soon as administratively practical. So with the COVID, with everyone working from home, or most working from home in a new environment at least, and the processes and controls may not be the same as they were 6 months ago. The DOL did put forth a notice indicating that they would not take enforcement action if a plan had failed to remit timely due to failure solely from COVID-19. So in that same notice, they also go on to say that it still needs to be done as fast as reasonably practical. What our takeaway from that notice is, there's no safe harbor to fund these late. And when I say late, if it's a day late, then okay, I'm sure that will not pose any issue. But if you're not funding these for weeks and weeks after they were withheld from the employee, that could potentially be a problem. So even though we're in a new environment, we shouldn't lose sight of the fact that employee deferrals should be still prioritized and funded timely. However, the DOL did say that there may be circumstances where a late deposit will be acceptable, and that's in certain events where, for instance, if you had furloughed individuals in your payroll department and they clearly could not fund these timely because there were other dire business needs they needed to attend to. So there are circumstances either way. If employees' withholdings are going to be funded later than they typically have been, we would recommend that it's clearly documented the reason why they're funded late, and that maintained in the file in case of an audit.
Well, that has been a lot of great information. I really, truly appreciate both of you, your knowledge, your expertise, all of the information. I want to tell the participants that if they have any additional questions, we're going to show out right now on the screen are some resources that you can go to gather more information from either Gallagher or Withum on the coronavirus. We both have a very comprehensive resource center that is available to you. I also think that, part of our goal as advisors for our clients is really to do that, not just be a compliance you know, somebody to fill the form out, check it off for you. We really want to be advisors to you. So I challenge you that if you have additional questions, you need us to take a look at your particular circumstances. Withum and Gallagher, we're both available. We're very proactive. Our mindset is not really to just fix things, even though we do have the ability to help you with that. We really want to advise you in the future and how you can make the best of your benefits for your employees in a cost-effective, proactive, and administratively responsible way. So please let us know your thoughts. You're going to have that survey that Jennifer talked about in a minute, and we really appreciate your time. And with that, that is the end of our presentation today. Thank you all.
Thanks, everyone.